Hello everyone, this is Peter from Investro.com and let's talk about the recent macroeconomic update in this short Investro video summary. Today is Friday, the 3rd of March, and let's look what happened during this week. So we will be talking about the EU inflation numbers and ECB expectations, how that have shifted over the previous days. We will also take a look at the recent or the latest Chinese macro news, and we will also take a look at US yield, which are rising toward their cycle highs. So basically the same situation or the same overall sentiment remains in the US market. Let's begin with the EU inflation. Uh, this week we saw some inflation update from the old continent, and as you can see that inflation in the Eurozone printed above analyst expectations, basically confirming the ongoing hawkish bias by the European Central Bank. What we saw is that the core inflation basically rose to 5.6% above the expectations of 5.3%, while the usual CPI or the usual inflation jumped or decreased, a little bit to 8.5%, but still above analyst projections of 8.2%. Overall, inflation remains very high, very elevated, and these month-to-month readings confirm that inflation is not going down as fast as expected, and that means that the European Central Bank will have to remain hawkish, will have to continue rising rates throughout this year to or trying to contain the rising inflation. Here is a little chart showing core inflation in the Eurozone. As you can see, it's starting in 2008, the core inflation has remained pretty static, around 1% yearly, but starting in 2022, we've seen this like very sharp trend higher, jumping to new record heights this week, as previously mentioned. And this chart is in no way showing that inflation pressures are contained, meaning that whoever expects the European Central Bank to slow down or basically to cut rates soon is probably mistaken, because this really doesn't look like the ECB has it under control, basically leading to further rate hikes along the way. That has also led to markets and investors slightly repricing their rate expectations going forward. For example, Goldman Sachs has recently said that they are updating their forecast for the ECB interest rates, and the investment giant now expects the European Central Bank rates to peak at 3.75 in June, against their previous estimate of 3.50. It's only a small increase of 0.25%, but it looks like from the previous chart, it looks like the ECB will have to go even higher than that, because the economic situation in the Eurozone is not as bad as previously feared, meaning or resulting in a more space for the European Central Bank to push rates even further higher. Their inflation target is at 2%, and we said previously that even the normal inflation is still above 8%. So this is like 4 times their initial goal, basically meaning that the situation is really out of control still after 3% of rate hikes already in. And as a result, the markets have entirely priced in a 50 basis point rate hike at the meeting in March. And basically, the market now thinks that the European Central Bank will have to raise by another 50 basis points in May. So it still looks like inflation is not slowing down. So maybe in a month or in 2 months, these expectations will be even more hawkish. So basically, the market will ask for another 50 basis point hike in the summer, or this 50 basis point hike in May could become, for example, 75 basis point hike. So that's for it for the inflation update from the Eurozone. Let's talk about some Chinese data which helped the sentiment during the week. As the manufacturing sector, which is really large in China, returned to expansion with 51.6 in February compared to 52 predicted and 49.9 before. So as long as these PMIs are above the 50 threshold, the market or managers in those companies are expecting economy to grow. If they are below 50, managers or big companies, corporations are expecting the economy to decrease. So this was really a positive print as Chinese manufacturing sector returned to the expansion territory, printing this number. And Wang Zi, a senior economist at Caixin Research Group, stated that after the most recent wave of COVID-19, industrial activity rebounded notably, and both manufacturing supply and demand grew last month as output progressively returned to normal and both domestic and foreign demand increased following a COVID policy shift. As you already knew, China eased their strict COVID zero policy a couple of weeks back. So basically, people could return to their normal lives in China, meaning, of course, that demand for everything will be going up because people are no longer restricted to their apartments or houses and they can go out and enjoy the life again. So they will be buying stuff, and that led to a nice upward push in the manufacturing PMI. And last but not last, let's look at what's happening in the US. We've had some US ISM manufacturing PMI index this week. It was closely followed by the traders, as it always is, and the February index increased to 47.7, indicating that the sector continues to be in a contraction area. As I told you recently, if the index is below 50, the managers are expecting a contraction in the economy or in the sector. So therefore, the manufacturing PMI in the US remains in a contraction zone. And what was a little bit of surprise is that the price paid index, we can call it the inflation index or inflation sub-index of this report, surged nearly 7 points to 51.3, meaning that inflation pressures are again building in the US manufacturing sector. As a result, the 10-year US Treasury bond rates soared to their highest level since early November 2022. The 10-year US yields are again above the 4% threshold. At the same time, the 2-year yield rallied to its highest level since June 2007 by rising toward the 5% psychological mark. So if we take a look at the chart, what's happening in the US bond market, we are seeing that this is the yield, the 2-year US yield, a weekly chart. That after this small consolidation, yields have broken up from this consolidation, basically confirming this long-term uptrend. And I think this week, that as I previously said, the yield have risen to the highest level in 2 decades, and this trend is doesn't look like it's stopping. So basically, we can expect further pressures on the yield curve in the next days or weeks. And that's it for this weekly update. Thanks for watching. If you like this video and for more content like this, subscribe to our YouTube channel and follow us on our social media. Thank you and have a nice and successful trading day. Bye bye.